Valens Research, Uniform Financial Analytics.
Now, just to prime you for Netflix on what you're looking at here, you're looking here at this chart at what we call the performance and valuation prime chart. And what this is actually the way that we better represent what real corporate profitability is for our clients to be able to understand, once you see through the noise, what a company's real returns are, what their real growth is, what the market is valuing them at, and then how the market has reacted. And so when you look here, what you're seeing is these orange bars here on the as report are in the ROA bar here. Return on assets, by the way, is what ROA stands for. These are what the as reported distorted ROAs are for Netflix over the last 15 years. These blue bars are what the uniform accounting adjusted ROA is for Netflix. When we make all of our 130 different uniform accounting and adjustments and see through the accounting noise and see what the real profitability is for Netflix. Right, what you can see here, which is so powerful for Netflix, is as reported accounting massively understates how profitable Netflix is. On an as reported accounting basis, basically you'd think Netflix was a below cost of capital return business. You'd say, how could this company possibly be worth more than $100 billion when they can't even make money on their strategy? But in reality, when we make the uniform accounting adjustments, what we can see is this isn't a company with an as reported ROA, this low orange ROA of 4.5%. It's actually a company that has incredibly robust returns. ROAs for Netflix are 40%. They aren't 4%, right? And so what you're also looking at here is these light blue bars are what sell-side analysts, when we take their numbers and we adjust them for uniform accounting, are forecasting for Netflix to do for the next 2 years. And these white bars are what the market's pricing in right now. So for Netflix, what the market is pricing in when you look at a company with $160 billion or so market cap. Also, we do the exact same thing with asset growth, where for asset growth, we're showing the blue bars, which are the uniform accounting adjusted asset growth, the amount that this company is reinvesting in its business. And the orange bars are the distorted as reported numbers. Right back here, for instance, in 2008, on an as reported basis, you would have thought that Netflix shrunk. In reality, Netflix grew almost grew by 50%, I should say, that year, as opposed to what as reported Metro was saying, which is something completely different. Similarly to what we have in the chart up here, what we have is in our light blue bars, we're showing what its forecasted asset growth to be going forward for the next year. And then these white bars are what the market's pricing in right now for Netflix. Down here, these last two charts, valued asset prime ratios are adjusted price to book metric, where we're basically saying, what is the company trading at relative to its invested capital base? Here, forward VE, that is our adjusted PE. So right now, you can see on an as reported PE basis, Netflix is basically trading at 60 times. In reality, Netflix is actually trading a third lower than that. Netflix is only trading at a 40 times multiple, not a 60 times multiple. Certainly not cheap. We're not saying that Netflix has a very low valuation relative to the market. It's still trading at 2 times market average valuations, but 2 times versus 3 times, very different valuation. In the last chart here, TSRR, that's TSR, or total shareholder return, relative to the market. And so what you're looking at here, total shareholder return is the total stock appreciation and dividend income the company has generated each year, and we do it relative to the market, meaning if this slants upwards, that means that the company outperformed the market. So in this situation, rising from 2 to 6 basically, the company had a 3x market return, and then as you can see, as you build year to year, that's an aggregate return. Now, what's really interesting and powerful here, and what we always pay attention to, is there is generally an incredibly strong relationship between the blue bars we see here and here in terms of growth and ROA and the TSR in a way that there often isn't when you look at the as reported metrics. Just looking here at Netflix, if you can see, right, ROA rose, and then therefore TSR rose with ROA as the company continued to grow. When uniform ROA fell, right, TSR fell. And now since then, right, as reported ROA has basically been flat to slightly up, while uniform ROA has basically over doubled, and the company has grown by 20 to 30 to 40% a year. Well, what's happened? The market's been paying attention to the uniform accounting metrics that show us improving returns. So that just shows you how to read this chart and what that means for the history. But right, the real question is, now that we understand we can't trust the as reported metrics for Netflix, because even though they tell us this company is barely a cost of capital business, it's actually producing massive amounts of cash flow. The next question isn't whether or not it's just a good company or not, right? Because a good company doesn't necessarily mean a good stock if the market already knows. And so when we look at Netflix, what jumps out to us is, right, the blue bars here are telling us returns have improved massively. The light blue bars, what the analysts are forecasting, says it's going to improve a little more, and also that the company that had been growing at 25 to 30% a year is going to slow down and start growing at 20 to 25% a year. Just stepping back, those things actually make sense, right? You're saying, hey, Netflix has improved massively its profitability, and it's also scaled. It's going to continue to be able to grow, maybe not as fast as it had previously, but going to continue to be able to grow. And also, returns after having leveled up, now that you have competition and everything else, you're not necessarily going to see returns take off a lot more. So what we can look at here is we can say, you know what? This actually kind of makes sense for Netflix. The white bars here for Netflix actually have a reasonable valuation for the company. This company does not look too expensive or too cheap. It looks like the market gets it. But let's say that you have a diversion view. Let's say that your view is, let's look at what happened here for Netflix. As Netflix has scaled their business, as they've expanded to Asia, as they've expanded to Europe, as they've expanded elsewhere, in reality, what's going on is they have basically said, we've got the same investment in content, but we're able to get more people to watch it. And if we get more people to watch it, that means a higher ROA for the business because I'm putting the same dollar in, but I'm getting more revenue out in the back end. So let's say that we do think that this company can continue to grow at 25% a year, but just like the improvement that we saw here from 20 to 40, let's say that we think in the next 5 years, 40 can go to 60. We can actually solve using the embedded expectation tool here to understand what Netflix would be worth. If you thought that this scenario is reasonable for Netflix, Netflix would have about 20% upside. So in reality, doesn't really even look that compelling in this scenario because the fact that that's not a lot of upside. But now let's say that you actually think, hey, Disney Plus, what HBO's offering as it comes out for Time Warner and obviously NBC's Peacock offering and everything else. Let's say that we actually think that Netflix is going to continue to try to grow, but returns are going to fall back to where they were previously because competition is going to increase. And what we see here is if this happened to Netflix right here, Netflix would have 50% downside. It would be worth half of what it is today. To me, that doesn't really look like a very good risk reward. If anything, that looks like a company that I actually might stay away from or might be tilted against, because for me to be able to see a lot of upside in the name, I have to make really aggressive assumptions. But for me to be able to get downside for the name, I don't have to go very far at all. So that's just context in terms of what we're looking at for Netflix. Now, for Netflix rate to be up 50% as opposed to down 50%, you need to see this go on for Netflix, which is what's a tough thing to see.
Valens Research, the world's leading source for uniform financial analytics.